Hello everyone, today's video is all about accounting for property investment versus property trading businesses. Now, notwithstanding that, it's always generally a good idea to split out into separate limited companies, property investing activities and property development, property trading businesses. The reason why is because your buy-to-let, your property investment company, long-term, you've got those assets for many, many years, that's the plan, it's an investment company. But if you're also doing some property developing and God forbid the developments go wrong, someone attacks it, creditors, you run out of money, whatever, all the other investments in that same company are at risk because of a disastrous development that you've unfortunately been part of. So for that reason alone, for commercial protection, I would always suggest splitting it out. If you've got property flipping or trading, speculation, one limited company, property investment in another limited company. And another good reason to do it is for the accounting, which is a bit of a nightmare if it's all one big mishmash, as I will explain today. So let's start off with property trading. So let's have a look at a property trading company that does nothing but property trading. And what does the profit and loss account look like? So I've just made up some numbers just to illustrate this. So let's assume that in a year, the property trading company offloads 2 units. So it sells 2 buildings, 2 houses, and for $500,000 each. So it gets £1 million in. Now, one of those properties they had in stock at the previous year end. So one of the properties they already had at the start of the year, another one that they've sold in year, they bought in year. And what else has happened in the year? Well, they've also bought another 2 properties that they haven't sold at the year end. So how does all that look in the accounts? Well, just look at the units, because that makes it easy to conceptualize. The units, the stock of units, houses. They sold 2 in the year, but they had 1 already there at the start of the year. They acquired 3. So there's 1 there. There's the one that they started off with. Then they sold 2, or bought 3, should be the other way around, isn't it? They're not going to have -1 at any point, but you see what I mean. So they started off with 1, they bought 3, they sold 2, and they're left with 2. So at the year end, there are 2 units in stock, okay, as a property trading business. Now assume that these properties, all of them cost 300 grand. So turnover, 2 units, 500 grand, purchases, 3 units at 300. But then what we have to put in to reduce the costs is the stock figure, or more specifically, the change in stock figure at the year end compared to the previous year. So at the previous year, we've already said one of these units was in stock. And at this year end, there are 2. Remember that 1 minus 2 plus 3 equals 2? There are 2 units left. So we started off with a cost of 300 grand. We're left at the year end with 600 grand of stock. That movement is an increase in stock of 300 grand. That needs to come off the cost, which makes sense because HMRC say, look, you get the tax deduction once it is sold. You can't just buy it and then have it sat there and get a tax deduction. We'll only give you the deduction when it's subsumed within the business, i.e. you offload it and you sell it. So that's general accounting principles applies to any business manufacturing widgets and having stock of widgets, not just property, but property trading businesses generally follow any other type of business from an accounting perspective in terms of your profit and your cost of sales. So turnover, purchases, change in the stock figure, that's your gross profit, 400,000. Which again conceptually makes sense. So it's a long way of going around the houses to explain it, but just on the, in your mind you go, well, okay, well they've sold 2 units, each cost 300, sold them for 500, that's 200 grand profit on each, 2 by 200 is 400, boom. So that's how you get it. I've explained all how that works, but it comes back to 400 grand, it's just 2 lots of 200, right? So that's how you show it. And then assume they've got admin expenses, back office expenses of modest amount, 50 grand. So they're left with a net profit of 350,000. So in the profit and loss account, the net, and then they pay tax on that, more or less. Now, I've done separate videos on, there's always differences between accounting profit and taxable profit. Normally a few little add backs, but sometimes it's not. Sometimes they're pretty much the same, but for things like, entertaining expenses, which may be disallowed, but for this illustration, assume net profit, accounts profit equals taxable profit. They'll pay tax 19% on 350 grand. Okay? Which is about 70 grand corporation tax on that transaction for the year on the selling of 2 properties. Okay, so how does this compare to a property investing company? Completely different look and feel of the accounts. So in a property investing company, all of the assets are on the balance sheet. They're not included in cost of sales and turnover and everything else. When you buy long-term assets for a buy-to-let portfolio, property investment company, all the big numbers are on the balance sheet, because that's where the units are held. They're carried, investment properties on the balance sheet, and every year we do what we call mark to market. We adjust for the fair value to write them up to their fair value, and the difference goes to the profit and loss account reserves, not to the profit and loss account itself, so that all the action really is on the balance sheet. The only thing that you'd see in a P&L for a property investing company is the rents, because that's what they do. They're in business to, they're not just in it for capital appreciation. They're there to obviously make a turn on by renting these units out. So the rental income is what comprises turnover. So let's say in this case 150 grand. Cost of sales. Now, cost of sales in this business, property investing, is things like agents, commissions, letting agents, 30 grand, gross profit 120. So it's not the sale of properties or the purchase of properties like it is in a property trading company. This is all to do with the rental income and the cost thereon. Admin expenses, again, say it's 50 grand. Operating profit, £70,000. So you can see it's a lot less than the 350,000 on the property trading. Now let's also assume that the property investment company sells £1 million worth of property, and assume that the property that they're selling in this year they actually already had, so it was on the balance sheet at the start of the year and it was marked up to the fair value, so it sat there. Balance sheet, start of the year, £1 million property for these 2 units, and they sell them in the year. So they get £1 million for these properties. Again, assume that they cost 300 grand each. So they cost them 600,000. They sold them for £1 million. They made a profit of 400,000. Exactly the same as here, but totally different. Turnover, purchases, cost of sales, change in stock, 400 grand. Over here, this 400 grand doesn't even appear on the profit loss account. So property trading business, it's the big number, gross profit, 400 grand. Property investment company, it's not even on the P&L. Why? Well, because on the balance sheet, we've already marked it up at its full value. So from an accountant's perspective, you're going to debit your bank account $1 million, and you're going to credit your investment properties $1 million, and they go. So there's nothing to hit the P&L. Profit on disposal, nil. Net profit 70. And you go, oh, well, that's fantastic. These guys are paying tax on 70 grand compared to these guys at 350, and they're both offloaded $1 million. No. Even though the 400 hasn't hit the P&L, we still have to pay tax. And it just happens that the mechanics of that all go on behind the scenes, as it were, from the accounts on the company tax return. So the company tax return for the property investment will go in the capital gain section. You pay corporation tax on capital gain, because strictly this is capital gain, and this is regular. This isn't capital gain. This is regular trading income, but investment is capital gain. Now companies pay corporation tax on capital gains, so we have to report this. So on the company tax return, even though profit on disposal is nil because it's already marked up at $1 million, in reality they made a 400 grand turn, goes on the tax return, sold it for $1 million, bought it for 600, 400 profit. So there's still, both of these guys are still paying the tax on the 400 grand profit that they've made on selling the £1 million, those £1 million 2 units for $1 million. So as you can see, the difference in accounting is huge. I mean, that bears no resemblance whatsoever to that. Like I said, property investment company, all the action on the balance sheet. Property trading company, all the action on the P&L, and the balance sheet there will just show the stock at cost. Again, it's another difference. That stock is at cost. These properties are at fair value. So it's very, very different. Now, what gets really confusing, and a lot of property, people who are in the property game, what they do is tend to start off, say, one buy to let, maybe get another one. They say, right, you know what? I'm going to do a bit of speculating now. I'm going to do a little bit of a flip. I'm going to buy property and sell. Before you know it, they've got two divisions, as it were, in the same limited company. So they've got both these things going on in one limited company. It's an absolute nightmare to account for it, because as you can see, they are so different, trading versus investing. But a lot of people just have it all under one company. And then, of course, what it would look like in the profit and loss account, you'd have two separate lines for turnover. You'd have turnover when you sell property. You'd have another line, turnover, for rental income. And it's just all amalgamated. It's a real mishmash. So, notwithstanding the fact that you want to make your accountant's life a lot easier and your life easier as a landlord to see where you are, so you're not trying to look at some sort of hybrid set of accounts, or you to help you run your business, you want to see these accounts, and not just the year-end accounts, but the regular management information throughout the year, split accordingly to help you run your business better. It's not just about making your accountant's life easier, it's making your life easier. And of course, coming back to the point I made at the start, commercial protection. God forbid anything happens on one of these, and all of that lot is at risk if it's in one limited company. So do bear that in mind. So just an overview there on the accounting differences between a property trading and a property investing company. Hope you liked the video. If you did, please do remember to subscribe if you haven't already. And as always, I'll see you soon.